I want to let everyone know we've got this will be recorded, and so if anyone isn't able to join us for the entire time, we'll record it. We'll have it available. But I'm Christina, Lindsey Orta. For those of you that don't know us, we've got our existing clients on here, as well as some of Cunningham Legal's clients on here as well. So it's both our Lindsey and Lindsey Ascent Wealth Management clients, as well as Cunningham Legal. And we've got Jim Cunningham, obviously, from Cunningham Legal.
Hello.
And Jim and I will probably be asking most of the questions today of Clarke. And Clarke Camper is with Capital Group. And the Capital Group, most people know from American Funds. So we use quite a bit of American Funds and have in our business for many, many years, and just a solid mutual fund company. And so the Capital Group, they actually do have a couple funds, one of which, Washington Mutual Fund, is run a lot based on decisions coming out of Washington. And Clarke happens to be the resident Washington expert for the Capital Group. And so he is very involved in what is happening with legislation, what's happening with proposed legislation. And without further ado, Clarke, I'll let you kind of share any other background that you would like to, but you're going to enlighten us on what's happening in Washington and what to expect, because I know that there's been quite a bit of proposed legislation, things that I think have been keeping Jim and I up at night as far as what's proposed.
Right. Excuse me. Thank you so much, Christina, and thanks, Jim. I'll certainly do my best. It's a crazy time. You know, Washington is always a bit crazy, but we've reached full craziness at this point. I think we can all agree on that. But so I'm speaking to you from just outside Washington in my home, and I'm head of government relations for Capital. So we actually have a global footprint. So I spend some time on Europe and a little bit in Asia government relations, but naturally spend most of my time and have a team of folks here in Washington. Really pleased to be with you today. Appreciate your taking the time to delve into something that, as I was sort of joking, but not always funny. You know, it's a very difficult, stressful situation. So I will do my best again to sort of inform you as best I can. A couple things I wanted to mention is, first, at Capital Group, we are assiduously non-partisan. I almost said bipartisan, but we're not even bipartisan. I say that because I don't care what stripe you are, what political stripe, what your beliefs are otherwise. If you care about retirement and savings, we're happy to talk to you. So if there's anything that I say that sounds like it's not analytic and is political, please understand that's not my intention in this day and age. I've been accused of particularly during the run-up to the election last year, I had people say, "Why do you love President Trump so much?" And people saying, "Why do you dislike President Trump so much?" So I sort of equal opportunity, but again, I'll do my best. The second thing, and then segues right into sort of my comments, which is anyone who tells you they know what's going to happen is not being truthful. That's not even, none of the leaders, Nancy Pelosi, Chuck Schumer, Joe Biden, and I'm only mentioning Democrats because, as I'll mention right now, they're really the only ones that are driving the train at this point, but they don't know what's going to happen. Nobody does. So what I'm going to try to do is give you my best view of where things are heading, but again, keep that in mind. In my comments, I wanted to have sort of three buckets that I'll talk about. One is where we stand right now, and so that's the most kind of fact-based. You can sort of trust my view the most at that particular bucket. Second bucket, actually this bucket too, you should be able to trust, is I want to talk a bit about provisions in the Democrats' reconciliation bill. I'll say more about what that sort of strange name means, but I want to talk about both the tax and the retirement investment provisions in the bill, and then finally head out. And here's where it really is more like talk, hanging out at a cocktail party or something. I'll talk about what I think is going to happen next year during the 2022 election, and what we could expect. In terms of the first bucket, again, going back to where do things stand right now, this, I could speak for a long time on this, so I'm going to try to just focus on the highlights. There are really three things that I would focus on to the extent you do want to watch what's happening in Washington. three large pieces of legislation that are moving through. They are not necessarily related, although given the way things have played out, they are all related. So the three are, first, lifting the debt ceiling, just like a credit limit for the U.S. to be able to continue borrowing. Second is a bipartisan infrastructure bill, a little over $1 trillion. It's bipartisan. And the third is a very partisan Democratic reconciliation bill. So again, let me step back or go into a little bit more detail. First, the debt ceiling. You may have noticed over the last couple of weeks, if you were watching Washington, it was hard to avoid, sadly, that there was a tussle over who was going to raise the debt ceiling. And again, remember, that's a credit limit that, the U.S. can only borrow by law X amount. And once you hit that limit, it's uncharted territory. But the fear is that financial markets understandably would not be comfortable with the fact that the U.S. was continuing to borrow above that limit. For as long, I've been around Washington for 20 some years, and the debt limit has always been an issue, political issue. However, in recent years, it's become more and more of a partisan issue. To boil it down right now, as you may have seen, Mitch McConnell and Senate Republicans have been saying that they will not give Democrats any votes to raise the debt ceiling, and have been saying that Democrats need to do it on their own. Democrats have resisted that, and the reason I'm talking about the Senate is, as you may know, on this issue, Nancy Pelosi has the votes in the House, so the focus is in the Senate, and as you probably know, the Senate is 50-50, Democrat and Republican, and so if you're Chuck Schumer, the leader of the Democrats, you cannot afford to lose a single Democrat in this vote. And how do we get, you may wonder, 50-50, how do we figure out who actually wins if it's a 50-50 vote? Well, the vice president, as you may know, is the tie vote. And in this case, Kamala Harris would be the tie vote, giving Democrats 51. But so this will play out throughout my comments. The Democrats can't afford to lose any Senate Democrats, any votes in the Senate. And long story short, Democrats have resisted being the only ones to raise the debt ceiling. What they fear is the political blame for raising the debt ceiling. They don't want to have the attack ads that will be run saying so-and-so, Senator so-and-so voted to raise the debt ceiling. Something that I think has been missed a little bit in the coverage is what Democrats really fear is to do it through a party line vote. Again, it's trying to spare you the sort of ridiculous complications here, but fundamentally to raise a debt ceiling through a party line vote, Democrats have to vote for a specific dollar amount that they're raising a debt ceiling to. In other words, you can't say we're raising the debt ceiling for 6 months or by $2 trillion. You actually have to say, the number that I've heard mostly is to say that the debt ceiling is raised to $29 trillion. That's why Chuck Schumer and Democrats don't want to vote to raise this thing on their own, because they understandably, and it is what it is, are going to be ads run saying so-and-so voted for a $29 trillion ceiling. Now, again, cutting through kind of the thickets, I do not think you're going to see the kind of, I think the debt ceiling is going to be raised. It's going to be done by Democrats on a party line vote one way or another. And I don't think you're going to see the same kind of brinksmanship that we saw over the last couple of weeks, where we were coming up to a date where the Treasury Department had said, hey, we're going to hit that debt ceiling if you don't vote, within days. And so ultimately, again, we could spend a lot of time talking about how that went, but ultimately Mitch McConnell agreed to allow a short-term increase and provided the votes to get Democrats and some Republicans to allow short-term increase. You'll hear a lot of people talk about that the debt ceiling needs to be, that vote will come back around December 3rd. I'm not quite sure where that number came from. I know that both Schumer and McConnell threw that number out there. We think it's longer than that. So probably late December, early January.
Mark, isn't that the day that everyone gets their Social Security deposited into their bank account on the 3rd? I think that might have been why.
Yeah, it's interesting. It could be, Jim. I think also I know that the funding for the government runs out on December 3rd. And so there was some thinking that you would combine this with a spending bill. And you notice I haven't mentioned the spending bill because that's one of those things that's always around and always you have to wrangle on. But yes, that's hanging out there too. But so to the extent you're really watching this, December 3rd is not a real deadline for the debt ceiling. Moving on then to the other two pieces, though, as I mentioned, there's the bipartisan infrastructure bill and there's the Democrat-only reconciliation bill. The top line takeaway is that it is far from certain that either of these bills is going to happen. And here's where I go back to what I said in the beginning. Anyone who tells you that they know what's going to happen is not being truthful. So I think conventional wisdom in Washington is that it's about 50-50 that both these bills go. And if they go, they're likely to go together. I'll say a little bit more about them in a second. My personal view is 60-40. So I'm a little more, expect a little more than your average Washington type that Democrats are going to get this done. Why? Because as you've probably seen, for many Democrats, it's existential that they feel that, if they don't pass these bills, they won't have anything to show for their efforts, particularly looking ahead to 2022. And so I think that's going to push, that pushes me beyond 50%. Why am I at 60? Well, Democrats don't have the votes right now. So let me step back again and say a little bit more about this. Why are Democrats driving the bus on this, so to speak? Well, as I said already, Democrats control the Senate, but just barely. The situation is virtually the same in the House. Nancy Pelosi leads Democrats, as you know, and though she can lose up to 3 Democratic votes, but essentially, virtually none on both the House and Senate. And what's happening is both in the House and Senate, you have warring factions within the Democratic Party that can't agree on what the substance should be, and particularly are holding hostage this bipartisan infrastructure bill, which has truly bipartisan support, passed in the Senate with something like 67 votes. The House would pass comfortably in the House as well, but Democrats in the warring factions are holding up that bipartisan bill, that again, everybody agrees on, trying to use it as leverage for fighting through this Democratic reconciliation bill. So I've mentioned reconciliation a couple times. Let me just tell you again, it's an arcane, strange word for what is simply a bill that can be passed once a year by a party line vote. That all you need is 51 votes to pass that bill. And so again, the name, the timing, the purpose for this for our discussion now, I think is irrelevant. Really, it can happen once a year, and all you have to do is get 50 votes. It's what the 2017 tax bill, the Trump tax bill, was passed on. Only Republican votes. It's now what Joe Biden is trying to pass on his human infrastructure bill, and that's what the reconciliation bill has become, passing only on party line votes. So just to step back, and again, as I said, we're nonpartisan here. It's really no way to run a railroad. Both parties use it, sort of a pox on both their houses, but it is what it is, and so that's the vehicle that is being used and will continue to be used, I think, in the future. Bipartisan infrastructure bill, as I already mentioned, that is a solid infrastructure package. So roads, highways, trains, all the stuff, waterways, stuff that you think of as solid infrastructure. As I say, there's broad bipartisan support for that. To put it in one easy basket, the Democratic only reconciliation bill is essentially human infrastructure. So it's childcare, it may include health issues, may include Medicare expansion, things like that. What's happening within the Democratic Party, from my view, is very similar to what happened with Republicans during the Tea Party. So you may remember in sort of 2009, 2010, you had a Tea Party movement that really came in, gave John Boehner, for instance, who was Speaker of the House for a period of time in that era, was a very traditional, down the road Republican, and gave him fits because all of a sudden within his caucus, he had sort of some rabble rousers from his view. Again, I don't mean to characterize it, but I think they saw themselves as rabble rousers. And there was a fight within the Republican caucus. And in fact, it cost John Boehner his job, as you may know. So I think what we're seeing now is that similar kind of dynamic within the Democratic caucus. You have a very strong progressive caucus that appears to be growing. And you have moderates, enough moderates in the House to form a sort of a block. But as I'd already mentioned, since Pelosi can only lose 3 votes, you don't have to be that big of a block to have some influence within the House Democratic caucus. You just have to be willing to hang together. In the Senate, we have a similar dynamic, although there are more kind of progressives and moderates. And 2 you've probably heard about who get most of the attention, which is Kyrsten Sinema from Arizona and Joe Manchin from West Virginia. Those 2 Democrats are the ones kind of, viewed as holding up the sort of passage of the reconciliation bill. That's not true. So for you to know, there are a number of Democrats, 5, 6, 7, who feel very similarly to Manchin and Sinema, but for a variety of reasons. They're happy. Joe Manchin loves to get this attention. I mean, every time he gets bashed by the left, I think it helps him at home in West Virginia. Not quite sure what Kyrsten Sinema, what sort of her theory is, because it does seem like she's getting bashed by both left and right at this point. But anyway, just know that they're not alone. There are probably, my guess is there are like 42 votes for a human infrastructure package in the Senate. Beyond that, good luck. So what's happening now, as you've probably seen, is, again, this battle's going on. The package is getting smaller. I've said all along, and not just me, we collectively, and I think it's been Washington consensus is, we thought this bill, you may know that Biden proposed $3.5 trillion. We have expected all along this might be in the 1.5 to 2 trillion range. And that's where we're coming down to. So it's very painful, as you can see, if you're a Democrat, there's lots of blood on the floor. It's very difficult. But the crazy part is this was always foreseeable. We always knew that the consensus only lay around 1.5 to 2 trillion. And so that's where we expect to land if they land the plane. Remember, again, I thought there was a 60% chance in my view that they land the plane. Again, I do not expect the bipartisan infrastructure bill would be passed unless the Democrat-only reconciliation bill is passed. I want to say again, I'm sorry not to talk about Republicans. I'm not trying to ignore them. It's just that in this sort of scenario I'm describing, they're bystanders. It's frustrating, but Democrats were also bystanders with the Trump tax bill, for instance, and they were equally frustrated. So I just want you to know that I'm trying to just describe the scenario as it exists. I thought, Jim, did you want to?
Yeah. So
let
me ask you a question. I'm a taxpayer and I hear, okay, it's $3.5 trillion and now it's smaller. And I hesitate to use the word smaller because I don't think 2 trillion is a small number. It's a massive,
it is not.
It is a massive deployment of dollars. Okay. Let's assume that the $1 trillion spending package gets through and we end up with a 1.5 or 2 trillion, whatever we're talking about. Which tax increases are you, if your ears to the rail, as it were, which tax increases are most likely? Is it the corporate tax? Is it the capital gains tax?
Yeah.
The repeal of the Trump era $5 million extra death tax exemption to me looks kind of dead, but maybe not.
Yeah.
I mean, what are you seeing that Dems are giving up on?
That's great. Yeah, thanks, Jim. And as I mentioned, so let's go into some of that, the tax and investment provisions. So my view, and again, I want to say I'm just crystal balling it here, but my view, and it's been this all along, is the tax increases we're going to see is a tax increase in the corporate rate from 21 to 25%. We are likely to see some increases in the international corporate space, in part because nobody understands it. So they just sort of find an amount to raise and they say, okay, we got $200 billion coming in from that. So that's going to happen. I do think individual tax, the highest individual rate is going to increase from 37 to 39.6. Although I would note that is slated to go into effect at the end of 2025 anyway. So all they would be doing is, bringing forward that increase. So I'm not trying to diminish it, but it's going to happen no matter what. And beyond that, I've been personally very skeptical that capital gains will be increased. The House passed package did increase capital gains to 25%. Again, I'm skeptical. Why? Well, first of all, Kyrsten Sinema is dead set against it. So the one thing that she's been willing to say that she is, sort of come down, at least privately with people and say, this is what I believe, is she does not want to see any increase in the capital gains rates. And there are a lot of other people, a lot of other moderate Democrats who have heartburn around that as well. As we all know, there's just enough concern around what that does to savings and investment to play with the cap gains rate. So again, I'm skeptical, but if it happens, I do not expect it to go be above 25%. So Joe Biden had proposed, as you may know, 39 to basically bring it up to the top individual rate of 39.6%. That was never realistic. So again, there just aren't the votes there. In here, I'm speaking personally, but thankfully, right? I do think what I could say on behalf of the firm is certainly with regard to corporate tax rates, we don't feel like an increase to 25% is generally material. Of course, it's going to depend on the particular company, but our analysts are comfortable with, 21, 25, we're in the same ballpark. It's still a lot lower than it was prior to the 2017 tax bill, so we're comfortable with that. In terms of the sort of the estate side, as you said, Jim, the idea of what Biden had proposed was to do away with the step-up basis. So that's when someone passes on, their heirs take the property and don't have to acknowledge this sort of any increase in the value of that property. You get to assume it at the level that the heir acquired it at. That's dead. It's not going to go anywhere. So in other words, no rule will be changed in terms, they won't take away the step-up basis piece. Yes, right. So that's absolutely gone. The piece that may happen is, as you mentioned, the state tax exemption currently is 11.6 million per individual. Again, another thing that's slated though to go away at the end of 2025. Right. I'm not trying to defend it in any way, shape, or form. I'm just saying that, look at it analytically. It's a couple of years bringing it forward back to what it was pre-2017, $5 million per individual. That was in the House Ways and Means passed bill. I think that if a bill makes it through the Senate, that part probably sticks.
So just to clarify on that, Clarke, for a moment, on the estate tax, that was one of the things that was very much a planning point for, I know Jim and I have been working with a lot of our clients, if the estate tax limits are going to go down. And so your feeling is that the sunset level that it's supposed to sunset to at the end of 2025 may be what it gets accelerated to. Yes, correct. Now, I should say again, we're all crystal balling it here. It is far from a certain thing because there has been a lot of, I think very valid pushback about what does it do to smaller businesses, family farms. Now, the tax writers claim that they have ways to carve out, those situations. Yeah. I'm honestly, you would know better than I how real that is. But I think there may be enough concern, right, that you can't make a carve out work, right, that the 5 million does not get enacted. But it certainly has. I think it's viewed by many as kind of a bit of a free shot, since it's going to happen in a couple of years anyway, and just giving the view from the ground. So it seems like it's likely or possible that it could be, whether it be the end of this year or next year, that we're looking at lower estate tax limits. Mm.
What about the Grantor? This may be too granular. Yeah, not at all. Grantor trust rules, because I have it here on my list. Right at the end of Obama's at the end of Obama's second administration, there was a push to eliminate Grantor trusts, and now it's come back with Biden. Is this something that is this something that's a real agenda? Is this on the progressive side of the Democrats? Is this on the more non-progressive? I don't know. Yeah, exactly. So the just in terms of where we are, Ways and Means Committee did indeed
do away with grantor trusts. From what I can tell, to your point, sort of what's behind this, it feels much more like they just needed to get a revenue number, and so they pulled this off the shelf. So as you may know, as crazy as this sounds, you have like tax analysts who work on, both parties, people who work on the Hill, that what they know is, we have this proposal, it's been around a long time, it's scored at, is the language they use. We believe that if we were to take this thing off the shelf and put it into law, it would bring in X amount of money. And that's what I think was behind the grantor trust piece. So it's been hard. We definitely have focused on that a lot. It affects a lot of investors generally, right, as you're reflecting. And so it's been very hard for us to figure out how likely it is that it actually goes into law. The thing we have been very clear with tax committees, both in the House and Senate, is the language right now is unclear on whether it includes a grandfather for existing trusts. So we have said, you absolutely, it is not fair if you were to have this, let's say it does get enacted and it goes into effect, let's say it goes into effect for 2022. Our point is, if you have a grantor trust that was, set up prior to that, it should not be affected. And so, as you can imagine, yes, people agree, because the idea of not having retroactive application is pretty unassailable. The worry is, end of the day, when they're in the back room cutting deals and trying to get a certain revenue amount, we might not win on that.
Yeah, and it's Clarke, it's almost like you have to be a tax lawyer or a CPA to understand what a grantor trust is. And I'm sure a lot of people watching this are like, I don't even know what a grantor trust is. Who cares if the whiz bang goes away? How involved are the sort of technical people on this? Is it just purely, are the elected officials and party leaders just looking at revenue numbers off a list of things that they can go after? Or, is this well thought out as well?
No, it's a great question. And oftentimes, honestly, there's a mixture of ideology and just trying to get the numbers. I do think on this one that many Democrats feel like a grantor trust is kind of it's the prototype of a tax break for the affluent. And so, right.
Because it is.
I wasn't going to say it, but yeah,
right.
Yeah, you're right. It's partly why we at American Funds, again, as you can imagine, we have to constantly decide what are we going to advocate for, or what are we going to stay on the sidelines for. And you're right. This one, we felt like we're focused on our individual investors. We don't want to look like we are advocating for, just for the affluent. This one definitely looks like that. Although, again, the principle of retroactivity is where we draw the line and say it's outrageous to apply anything like this retroactively.
So
it's difficult when you've got investors that are counting on the income stream from these trusts that they set up for the types of planning that they did. And so there's been investments made to achieve certain income goals for those clients, and they wouldn't have done some of the planning they did. So the retroactive is definitely of grave concern. And while we're on the retroactive, I'm just going to take a step back, because that's the number one question that we're getting is there really a possibility of having retroactive capital gains taxes changing? And because there's been a lot of discussion about that could be retroactive to April of this year for any capital gains.
Yeah. So there is some possibility. I'm sorry to say there's some possibility. However, I think it's very slim that it would be retroactive. Yes. So what the Ways and Means Committee did was, when they enacted this provision, I think it was September 15 or 14, they said that the capital gains rate, the hike to 25%, would begin essentially for the year tax year 2021, basically, to boil it down. So effectively, as you're saying, Christina, so it's effectively retroactive to 2021. I think that even if cap gains rates are increased, it's very unlikely to stand, for the reason that we're just discussing here. I spoke about this with Ron Wyden, who's the Senate Finance Committee chair. You may know, a senator from Oregon and a self-described liberal. He agreed that it was not at all fair to have retroactive application of capital gains. And he's someone who wants them to be increased. Again, I'm skeptical that he has all of his Democratic colleagues with him, but I think that's telling that most members realize it's really, it's appalling enough to raise taxes. It's really appalling to raise them retroactively. So again, so I think, there's always a small chance. I think it's very unlikely.
Yeah. For those of you who have questions, go ahead and put it in the Q&A and hopefully we'll get to those. And Clarke, I have another question on the partnership. Partnership taxation is known as the most complex area of taxation in the Internal Revenue Code. There's nothing that's more, maybe international partnership taxation might be sort of the cherry on top, so to speak. But the most complex area of taxation is partnership taxation. And one reason is there's a lot of flexibility with partnerships. There's a lot of ability to allocate profits and losses and give stuff away and still be in control. Now I was reading that they might be unwinding a lot of those rules. Is that still on the chopping block, or is this, too esoteric for normal lawmakers to really, frankly, understand? I don't want to offend anyone if they're a lawmaker watching this, but it's technical stuff.
No, I agree. It is quite esoteric. Back to Ron Wyden, who I just was mentioning, he proposed exactly overhauling the partnership rules. Also, one piece of that didn't get a lot of attention was that it would change tax treatment of ETFs, exchange traded funds, and would make them have the same tax treatment as mutual funds. So it would take away, not entirely from what I understand, our analytic people said, it would take away most of the tax benefits from ETFs, not all. But to your point, this was under a package of changing the partnership rules. I think it, again, extremely unlikely, seems not to have gotten any traction. Part of why I was speaking to Wyden, sort of, again, in my job, I have to make sure to get to where the decision makers are. So I traveled a ways to try to get to a place where I was fortunate to get like 5 minutes with a guy in a sidebar, and he showed no, and I asked specifically about this provision, and he just showed no kind of emotional attachment to it, unlike some other provisions that he's been pushing. So I think it's unlikely. I hear what you're saying about the partnership rules, complicated and esoteric, and that doesn't help his cause, but I also think he's felt to me more like his staff put it out there as a proposal, and he was not going to sort of break glass to try to get it across the line. So
I know the wealth tax was part of the 2020 presidential cycle. Is that still floating around? There's some constitutional hurdles, I think. In just being it for the federal government to even be able to impose a wealth tax without there being some type of transfer or some movement of money. Is there a movement to tax wealth or to tax securities transactions? You hear Bernie Sanders say, "Oh, it's a penny a share," or whatever he says. That's nothing, and you can it'll just raise all this money magically.
Yep. So first in the wealth tax, again, there absolutely are not the votes for that among the Democratic caucus, probably in both sides of the House, but certainly, both sides of Congress. Certainly in the Senate, there are not the votes, right? The Elizabeth Warrens of the world, the Bernie Sanders, all want a wealth tax. There just aren't the votes for it. In terms of, what you referenced is sometimes called a transaction tax. So as Jim said, just a sliver off every single trade. I actually used to run government affairs for the New York Stock Exchange. And, we know that little sliver would impact trading a lot. As you can imagine, it would certainly drive decisions. I think it's very unlikely that would be enacted. Again, certainly with this Congress, that there are enough Democrats who realize that it has ramifications, far beyond that would be unintended, and it's not the panacea that people like Bernie Sanders say it is. That one I'm less firm on, in the sense of wealth tax. I'm 100% confident the votes aren't there. This one, I'm 100% confident the votes aren't there now, but could President Biden twist arms and get it there? Possible in terms of a transactions tax, but he has not been at all in on this in the way that I would think he would need to be to actually make it happen.
So I saw go on.
I was just going to say, while we're on taxation, I know that you do cover global markets as well. with global taxation, if you can touch on global tax and kind of this flat global tax and trade tax, and then also in addition to that, the global environment does not seem to be doing nearly as much quantitative easing as the US, which is really driving continued growth in the US. And I think the consensus across every single economist and analyst you speak to is don't fight the Fed. The Fed is just adding gasoline to the economic growth in the US. But specifically with quantitative easing and global taxation, can you touch on that?
Sure. The one thing you may have seen in the press is this idea of a global minimum tax that Janet Yellen has been pushing, and the some of the international bodies, the OECD, you may have heard of that. I'm not quite sure I understand exactly what they do, but I do know they try to align countries on international tax policy. It's fascinating to me because even over the last couple of days, there's been a lot of conversation around, or at least press reporting, that basically the vast majority of countries have decided to have a 15% minimum corporate tax. The reason that I'm skeptical is because from everything I know, in the U.S. case, that would have to be enacted into law. And it is possible that Democrats could do that as part of their tax bill. But as I've been saying, first of all, there may not be a tax bill. And also, I think nobody knows exactly what it means. And I don't think you're not going to get a lot of Democrats just signing up for it just because Janet Yellen says it's a good thing. So I think there's considerable uncertainty around what the U.S. does. And then you see other countries globally that have been sort of hesitant to sign up. Ireland is one. Hungary is another, so it feels to me like this has been cobbled together, and that this may be the high point in terms of, we've gotten a global agreement. The idea, by the way, is to try to curb companies from basing some of their operations, or at least having headquarters in certain low tax countries. So it may, I think we could all agree it's probably a laudable goal, but I think realistically it's very difficult. In terms of the U.S. international tax provisions, I'm definitely not an expert on it. So there's something called GILTI that you may hear people talk about that was instituted as part of 2017. What I do know is, again, the Biden administration wants to overhaul it in a way that would increase the amount of money that comes in. And that's where I think your average legislator, to the extent they can be convinced that, it's, again, I think the 15% thing by itself is going to need to be cooked more. But the idea of overhauling something like GILTI that's already on the books, most of them will say, sure, how much does it raise? So again, I think there will be changes there, but truly nobody knows exactly what those are going to be. In terms of QE and frankly, inflation, you were kind not to mention, but I think that was probably implied in your question. I'm no economist. I'm not an expert. I do live a couple blocks from Jay Powell, so he's sort of right over there. And as it turns, Gary Gensler lives from the SEC, lives one block over this way too. So I'm surrounded by folks, but Democrats are scared to death of inflation. So you hear them saying that, oh, it's transitory, we're not worried about it. It certainly seems to be the Fed's view, although they may be backing off that, right? So, Democrats are scared to death when you talk to them privately. Republicans obviously are not happy about it, but politically it's a gift, and you've seen them sort of beat that. This is Joe Biden's economy. We're at high inflation, high energy prices. One thing that I think isn't getting enough attention is gas prices. Mm-hmm. That, I think at the pump, obviously, and I know in California, everything I know, your gas prices.
It's $5 a gallon.
Right? So you see things like that. And I think, whether that's directly tied to inflation or not, I just think politically it's incredibly powerful and damaging. Assuming that, God forbid, but I think we agree that it does seem like we're on a pathway for higher inflation. I think that's going to be, the headwind is a polite term in terms of 2022 for Democrats.
Yeah, Clarke, I saw in the news today, and probably most people saw because it was one of these headlines that pops up on your smartphone, but that Social Security benefits are going to be increasing 5.9%. That was announced today. That's the single biggest percentage increase in 40 years. And I'm wondering, we have the Reagan Revolution that started in 1981 that changed tax policy. Can we kind of stick a fork in it and say, the Reagan Revolution, born in 1981, died in 2021? Is it over, number one? And secondly, what happens when inflation exceeds economic growth? What happens if your inflation, your nominal inflation, it exceeds your economic growth? If you can comment on that.
Yeah, sure. Well, and again, I want to be clear, I'm no economist, but but the fear is that we return to some version of the late 1970s. You hear some talk about stagflation, where you have sort of a stagnant economy and inflation growing. And so, you get everything from, interest rates of that era were just astronomical. Hopefully, again, God forbid, I hope we don't see them again like that, but they certainly could be. And, when you see just economically, you see things like the supply chain problems that we're having right now. You may have seen the White House today had a big forum or focus on supply chain. They're scared to death about that. Again, they're going to try to put a good face on it in public, but these signs about the economy don't lead you to believe that we're, kind of having a nice, smooth return to, growth and stability that we all were hoping for earlier in the year. So, so I don't want to be too, too, alarmist, but I think, things on the pessimistic side, things could be very, very bad, I think, over the next couple of years. And
I think one of the challenges, I know Christina and I each run businesses, and, there are a lot of people watching who run a business or have run a business. I think probably one of the biggest challenges, even if you're a consumer or a business owner, there's no playbook that's been written on how to come out of a global pandemic in a modern economy. So we're really I think a lot of us are using our gut. We're trying to pay attention to data and signals, but we're really not quite sure how to interpret those and what to make of those. And I suspect that people in government are probably in the same place, because I think you could make the argument that it really is crazy to raise taxes coming out of a pandemic like that. That just out of the gate does not make sense, which then begs the question, what are taxes for and who are they for? What is the point of taxation? We just dumped $3.5 trillion into our economy with PPP loans and stimulus. Why is there even federal tax? I mean, is anyone talking about that? Why is there a federal income tax? What's the point? Do we just print money indefinitely? I think, those are all great points. I think, depending upon who you talk to, people make various parts of that argument. I don't know if you've heard about a modern monetary theory. You hear about MMTers who believe, just as you said, that hey, deficits don't matter. The government just prints money and don't worry about it. I think that they've been, the press has overhyped their influence in Washington. Again, maybe the Elizabeth Warrens, the Bernie Sanders of the world will listen to them. The vast majority of people don't. On the other hand, it is interesting to me, you're talking about sort of why do we have taxes in the first place? While looking back to the 2017 tax bill and having been very, very involved with that, and as I'd mentioned then, we were working with Republicans only, there was a desire to bring down taxes, but nobody was ever saying, hey, why do we have taxes? So it is interesting. I think that for good or bad, it feels like there's kind of a consensus around, we're basically, maybe another way, I don't know if you feel this is a fair way, Jim, to describe what you're saying, but it's sort of like we're fighting over a lot of the details here, but we're kind of in the same ballpark. What Biden proposed might be a different ballpark because he proposed raising so many taxes, but when it comes down to when you're seeing what Democrats are actually doing, as you heard, is they're raising it, kind of stretching each thing a little bit, but no one is stepping back and saying, right, does this make sense? Should we have some kind of a different system or we're not going back to
value-added tax, or
we're not going back to a 70% marginal tax rate, which we had in the 70s. No one's talking about that. So Clarke, if we can just kind of take a little turn here, and a lot of our clients this year have invested in solar and commercial solar. And we've talked a lot about that on our YouTube page. We've talked a lot about the push. The United States, whether you're Democrat or Republican, agrees that we need to take solar production from 3 to 30% of US power. I believe it's by 2030 or 2035, which I don't know how it's even possible that could happen. I don't know that there's enough steel coming out of the mills to create the commercial. And we're not talking about like solar panels on your house. It's when you go to IKEA and they've got, 5 acres of solar panels. Is there anything that you've seen that's bringing back the 30% tax credit for solar projects? I know it's a granular question. I don't mean to catch you off guard. Or is there a way to
not at all.
Solar like oil and gas, where you don't have to have active participation? Yeah.
So I have to confess, Jim, that's not an area I follow. Okay. But with that caveat, I have not heard discussion of a solar credit. But again, it may reflect my ignorance. No. What I would say more broadly is, though, I think it feels to me like the administration has talked a huge game on climate, and it's kind of like, okay, where's the action? And Treasury Department, for instance, released just a couple of days ago a climate plan pursuant to a Biden directive, earlier in the year. Okay, we kind of expect that. It's a nothing burger. I don't mean to diminish the hard work of people at Treasury who put it together, but it's a big report that basically says, climate's an issue, and we got to figure out how to sort of incorporate it into our financial analyses and our risk analyses. So that's a little unfair, but not that much. So I too, it feels like, hey, solar, like, what's not to love? Okay,
there should definitely be.
Why?
What? Hello.
Yeah. There should. I was going to say there should definitely be some more focus on energy credits or something along those lines, because the government can't do the energy growth and infrastructure alone, and there should be some more tax incentives. But just to bring it back to some tax stuff, because I know that is a great question. In particular, you spoke on step up in basis. One of the other things we talked about was the 1031 market, and that was a huge hot topic of potentially trying to close some loopholes in the 1031 market. And a lot of families, farms, real estate owners, a lot of people in California are real estate rich, cash poor. And so the 1031 market, not only does it support the deferral of taxation and the step up in basis for the heirs, but it also employs realtors, carpenters, construction workers, the domino effect, property managers. The domino effect of the industries it impacts is quite significant. So have you heard anything on the 1031 market?
So what I've heard, first of all, I don't think anything's going to happen there to change existing law. What I've heard is the Biden administration had proposed, to sort of close that loophole. I'm using their terminology. But it is not in the Ways and Means bill, and I haven't heard any discussion of it. So it feels to me sort of like the step up basis, that argument by and large has been won by people who say, you're going to hurt the people you're supposedly trying to help. So I hopefully we're safe on that. I know it came up as part of the 2017 tax bill, as you probably well remember, and looked like changes might be in place that might come into place then, but they did not. So
and then
the real estate industry was very effective at lobbying that.
Yeah, and just for the sake of time too, I just want to ask another question and remind people, if they have questions, they can certainly type them into the Q&A panel, and we'll answer those questions that might be out there. With respect to IRAs and Roth conversions, I know since you and I spoke a few weeks ago, there's been a lot of change on that there was the expectation that a Roth conversion after this year may be limited to $100,000 a year. And so a lot of our clients and people that have deferred in their 401ks and their IRAs all these years, which is a good vehicle for savings, and you have time to defer, but it's this, now they're looking at retiring with this pending required distribution at 72. That's quite significant. So some people are starting to convert and pay the taxes on getting it to an IRA. What have you seen with respect to the large IRA distribution requirements and Roth conversions.
Yeah. So the Ways and Means Committee passed changes, big changes to Roth in terms of Roth conversions. What they said was, if you are a high earner, and it's roughly defined an individual at $400,000 taxable income, and a little higher for joint filers. But if you're affluent, is the theory, you may not do a traditional a Roth conversion, from a traditional IRA or 401k, as you described, into a Roth. You may, however, if you're below that income level. So the idea is, again, not increasing taxes on working or middle class families. What they also did, though, was to say that if you were trying to convert a non-Roth, some kind of after-tax vehicle into a Roth, that's prohibited regardless of income. So I don't know the extent, honestly, that is used kind of in the real world. The part I hear much more is the traditional IRA or 401k savings vehicle that would be converted into a Roth.
Are you hearing a limit on the 100,000? Have you heard that that's going through?
So I'm not right. So I've not heard the limit.
Okay.
So there has been, where the limit has come in is there's been talk about what is shorthand called mega IRAs.
Yeah.
And this, as you may know, the press got wind of Peter Thiel, the tech investor, had a $5 billion IRA.
Does.
In fairness, it does. Right. Exactly. Thanks, Jim. Good correction. And in fairness, right, it does sound like, really? Like, it's definitely. So what the Ways and Means Committee has proposed is to have essentially, it's complicated, but you can't have an IRA that is more than $10 million, or collectively can't have IRAs that exceed 20 million. Or if that's the case, then they have a series of forced required minimum distributions that occur. I think that if there is a tax bill, a reconciliation bill, I think some portion of this sticks in terms of mega IRAs for the reason I mentioned, that I think politically, and also if you just ask the average person on the street, it does seem a little crazy. But who knows what form it is, because I know there's been a lot of criticism of what the Ways and Means Committee did. But 10 million, again, was the threshold at which they said no IRA could be more than that.
There's another proposal related to IRAs to prohibit the holding of non-publicly traded securities in an IRA. Now, non-publicly traded securities have two forms.
Right.
Venture capital, startup company, pre-IPO. But what about a client who has a self-directed IRA and has an LLC that owns real property? And a fair amount of our clients have that structure.
Sure.
Would that go away? I mean, would kind of this owning real estate through a self-directed IRA, were they meaning to include that as a non-publicly traded security, or did they get that granular?
Yeah, I don't know if they got that granular. My understanding is that it all would be covered, that you would say that you couldn't have those investments in an IRA. I don't think it stands for the reason, though, that you just described, right? I mean, it is, the impact is too wide ranging. It's not what it sounds like when you first describe it. And so I, did pass the Ways and Means Committee, but again, this thing is going to look quite different once it goes through the Senate, and assuming they even get a bill. So I would be very surprised. If I can just say too, just one thing that's powerful on all this stuff is Republicans rightly have said Democrats are playing with your retirement. Right. That's a third rail, right, as you can imagine. So I think it's one thing, mega IRAs, I think, again, reasonable people could differ around whether you should have those. But when you're really changing, as you say, some of the specifics about what can be held in an IRA, for instance, and maybe even the Roth conversion thing, although that one feels like maybe it's a little more kind of, in the weeds. But the point is, don't go messing with people's retirement. That's a good way to lose elections.
And I'll just give, as we kind of draw to a close here, I'll just give you a dose of real world reality. People who have $50 million IRAs, guess what they do? They take a lot of that money out of their IRA before they die anyway, because they want to pay the income tax. Because when you run the numbers, sometimes it makes sense to take money out, pay the income tax, because, right? Whether you're doing a Roth conversion or not, but sometimes that makes more sense than keeping it. in the IRA. So I'm not sure that's going to really raise revenue so much as be a virtue signal, if you will, that you know, people should not be twisting the retirement laws to create mega fortunes.
Well, and typically the types of planning that we're doing, I know, Clarke, you're also a JD from Harvard, and Jim, fellow.
I'm
not from Harvard, but fellow JD. But
I'm glad you told me at the end, because I would have been intimidated. I wouldn't have said anything.
No, obviously not.
But some of the planning from a legal perspective that, you know, ultimately what a lot ends up happening with people that have those large IRAs is a lot of charitable planning. And so, you know, it ends up being maybe not as much of a tax revenue, you know, grab for either party to collect revenue. It ends up being more of a charitable strategy that we end up doing on the legal side to help plan. But in coming to close, if anyone else has any questions, certainly type those in. We will be having an economic, I know this is still focused mostly on what policy is coming out of Washington with Clarke. And Clarke, I do want to close with what is most concerning right now to the capital group, especially with regards to the average investor that you're seeing that could come to fruition. What's most concerning? What are you guys trying to lobby against? And what do you think is the biggest relief? I mean, I think it sounds like capital gains and some of those things are relief that we've seen. So if you want to think about that for a moment, I'll just remind everyone on the webcast that we do have an economic update. So we will have more of an economic outlook in a month. That'll be on November 18th, which will be, you know, definitely dealing more with the economic side of things in our forecasts. And we'll have another month into this, you know, year of what might come out of Washington from a tax perspective. We might have even more clarity. But if you could just close us with kind of some of your, some of those questions.
Yeah. Well, I'd say the one thing that keeps me awake at night, it's not going to be something that maybe, I don't know how of interest it is to your audience, to our group here today, but, and it's not something you might have anticipated. It is with the Federal Trade Commission. So the FTC has a proposal that actually came out during the Trump administration, Republican-controlled FTC at that point, that would limit any asset manager from holding more than 10% of a company across your entire firm. So that would mean that for a capital group, we couldn't hold 10% more, 10% of any company across our entire firm. So we're fortunate, we manage about $2.5 trillion of money. So you would look at all of our, not just an individual fund, you'd look across our entire firm. That especially would hurt, as you can imagine, some of the large index providers. So BlackRock, Vanguard, State Street. It's not even clear what would happen, as you can imagine, if you have an index fund where you're tracking an index and you're just following, again, the index, and it turns out you own 12% of a company. It's not even, you know, you obviously, something has to give, because you wouldn't be permitted by the FTC to own that. On the other hand, you've told your investors that, you know, this is the way the index fund is going to work. Yeah, without going into detail, it's not at all clear, and not for lack of trying by us in the industry, but it's not clear that policymakers really understand the ramifications of that. I think they think that, oh, it sounds bad to own more than 10% of a company. And, you know, we think that particularly for smaller firms, in terms of capital formation, it's not at all unusual, as you can imagine, that we might own more than 10% of a company, particularly when they're smaller. So this would be terrible for capital formation, and would end up harming investors ultimately, because our returns would be limited. So again, I don't know if it's that interesting, but it's an example of like a wacky Washington policy that, again, I repeat, like you would think it would come out of the current FTC. It didn't. It came out of, you know, the Trump FTC. So it's you know, you never know what you're going to get in Washington.
Interesting.
Right. Well, thank you, Clarke. Thanks, Christina.
Yes, thank you. I don't think we have any other questions, but certainly thank you, Clarke, for your time. And
thank you. Hope it's been helpful.
Very much so. It's hard to keep track of what's happening in Washington. It's a daily challenge. So thanks for keeping us apprised. Yes. And sounds like a lot of the concerns that have been out there, some of them have been put to bed, at least at this point.
Yes. Thanks. Yeah, hopefully. So thanks. Take care.
Thank you, everybody.
Thanks. Bye-bye.